Good afternoon, ladies and gentlemen, and welcome to another show of Market Mondays. On behalf of management, we hope that you've had a spectacular Easter break and that you and your families have enjoyed the long weekend. My name is Seng Yao, and I'm basically standing in for Thilan Wickramasinghe, who is currently on leave today. Over the last week, we want to basically highlight three observations that has come to the attention of the research team, which are basically red flags in nature. These flags unfortunately suggest that markets may be long overdue for a pullback. Uh, Let me just walk you through. The observation that we have come across are basically these. Observation number one, it's all about valuation. Since the Federal Reserve's affirmation that is on track to lower interest rates by this year, markets have traded up higher, and the S&P 500 is now trading at 14% above its 200-day moving average and a 33% premium to its average price to earnings ratio over the last 20 years. Now, it goes without saying that both of these indicators are basically historical extremes. Observation number two is generative AI. Now, generative AI remains a hot theme with Amazon's latest 2.75 billion investment deal in AI startup Anthropic last week. But this deal is just an alliance like other alliances that were recently announced by Microsoft and the likes, and all point to basically a four-letter acronym of FOMO, or fear of missing out, basically from having access to the most fundamental IP, the algorithms. Now, big tech companies represent a significant portion of the momentum trade, as we know. Now, this is an investment style that is basically based on upward price momentum. As a case in point, the MSCI USA Momentum Index is up 20% since the start of this year, compared to with a rise of about only 10% for the S&P 500. What is noteworthy is that the momentum trade has a reputation for producing very strong outward, sometimes parabolic outperformance, and followed by very painful corrections. So this is something that we feel that you as our investors need to be mindful of. Observation number three, and by far the biggest threat to ASEAN markets may be the yen. And when the BOJ basically abandoned an 8-year stretch of negative rates on March 18 by raising its overnight rate from minus 0.1% to 0%, the yen actually declined against the US dollar. As hopes for another rate increase has basically faded because Japan's economic recovery remains on the soft side. The Japanese yen's weakness may be a concern for ASEAN exporters because many are listed companies here in the regional bourses. So the context of our conversation today will center around the theme of playing defensive. And our first speaker on the call today is Alan from the FX team. Alan, welcome to the show. Now, every market cycle is somewhat different, but I do recall that when the yen last traded around 150 and broke past this in August of 1998. That event basically coincided with the Asian financial crisis. I'm sure this cycle is not a setup for a replay of the Asian financial crisis, but a weak yen, as I've alluded to earlier, is generally not good news for ASEAN exporters. So, Alan, let me first draw your attention to the Tankan survey, which was released this morning, and the March CPI data, which is coming due on the 19th of April. What is your immediate takeaway of the Japanese industrial sentiment? And as a follow-up question, what is your expectation of the yen direction? Alan?
Okay, so I mean, we've seen the Tankan survey out this morning. It was a bit mixed as it is. It wasn't implying either very strong economy or very weak. We had large manufacturing index, slow down a little bit, but then the services side was actually stronger. But what was most important about that survey we saw was that businesses actually expect that inflation should be at 2.1% in the next 5 years, which is very important. That's above the BOJ's target of 2%. Now, onto the CPI data, which you talked about in March, that was to do with, now we still think it's going to come up above 2%, but they could be, we are wary of the risk of moderation, especially the Tokyo CPI data that came out last week. And that showed a moderation, but that doesn't mean there is a moderation trend intact for the CPI right now, because in the coming months, it could actually pick up a little bit, given that we have a few things happening, with wage increases, having been negotiated in the recent Rengo, rounds negotiation, and then the termination of government subsidies coming in and a rise of electricity prices. So so inflation could actually still, pick up, as I said. And what does this all mean, data wise, actually, for the direction of the yen? And what we're seeing here is that it's actually just means that overall this data is still the policy path of the BOJ does not change. It's still a normalization path they're going to be able to take because inflation still holds up. The economy is still going to be, on the path of transition itself, towards that normalization which they're aiming for. And again, what does this imply for the yen, for the dollar yen? And for the dollar yen, normalization in the eyes of the BOJ means gradual and slow, rate hikes as they kind of see it as. And we are calling in, for 25 basis points in October and another next year in June. Therefore, yield differentials are going to be wide. Repatriation back into Japan is going to be slow, and therefore, we see it at 152 by the end of the, Q2 in 2024. We don't see so much upside. It's probably limited simply because of the job owning and the risk of intervention. Yeah.
Okay. Well, that's an interesting observation. Now, I just want to point back to your last remark that basically the repatriation of the yen of capital flows back to the yen might be a bit choppy and even slow. And I think that it's fair to say that this is also, I mean, investors also need to take into context about how strong the US dollar will be for the rest of the year. With the Fed only expected to cut interest rates in the second half of this year, does your research show that the USD will necessarily weaken in this scenario?
Yes, we are actually seeing the possibility that it will weaken still because the Feds are going to engage in rate cuts. But we're actually seeing it likely to be slow and gradual, simply because the path downwards for this inflation is going to be bumpy. U.S. data is still going to hold strongly, and U.S. exceptionalism is going to be there still, as it is. So yes, it will be a more slow and gradual path as it is. Currently, end quarter for Q2, we see it at 104.62. By the end of the year, it will go down a little bit to 102, and those are very elevated levels still for the dollar as we see it. Yeah.
Okay. All right. So maybe my last question then to kind of like wrap this up for investors is that do you think that basically FX market participants will basically continue with the carry trade to sell the yen and perhaps long positions in high yielding currencies like the USD?
Very much so, actually. We believe that carry trade is going to persist. Like I've mentioned earlier, normalization in the BOJ is gradual and slow. It's going to be, only 25 basis points by October, 25 basis points possibly in June that we see it as. And then the Fed, on the other hand, I've mentioned, it's a risk of seeing slower pace of rate cuts, given the strength of the US economy. Yield differential is going to remain wide. And therefore, market players are going to say that, it's still good to sell the yen in long positions in high yielding currencies. And anyway, it will be very, very expensive for those who want to go really, truly bullish on the yen. But we would want to note, like I mentioned earlier, that dollar yen upside is limited simply because of the risk of interventions and, drop boning from the government officials. And ultimately, I don't see that the BOJ would be so keen for the dollar yen to be so high. More likely, in our house view, we actually see it probably around a range of 140 to 150 will be where they will be comfortable in. Regardless, that's still a very elevated level for dollar yen.
Okay, great. Thank you very much. We'll leave it at that, Alan. Thank you so much
Okay,
for your
thank you.
contribution this morning. Yeah. Nick, I'm going to basically switch to charts at the moment. Nick is basically a regional chartist and has been doing a lot of work about the technical momentum indicators, particularly regarding the ASEAN region. So I'm going to basically invite Nick to talk about a little about the ASEAN outlook, the STI outlook, and lastly, perhaps one or two sectors where he feels most strongly or confident in for investors to basically park their monies in if the markets do turn off. Nick, could you basically just walk us through your chart, please? I think what we're looking at here is basically the FTSE ASEAN chart. Nick?
All right. Thank you for having me today, Saya. All right. If you look on the screen right now, the FTSE Asian 40 is our weekly highlight that we had in our Traders Almanac for the region. Now, based on what we seen on the last week, we expecting some pullback and the consolidation, and it was indeed consolidation. The midweek rebound last Thursday was not sustainable as the index actually traded lower, taking down below the red line level. Or the red line represent by something the line we call Kijun, and is actually represent a short term trend for the indicator called Ichimoku Kinko here. But the good thing is since November, the index has been traded pretty much in the uptrend channel. So right now we're expecting a consolidation or at least a minor correction toward the current support which sit within at 10,200 and 10,350. But we do think the downside could be kept at least in near term. And if you look on the screen, there are also the blue color line there. There is a representation of the Kumo or Ichimoku cloud, suggesting that there is a plenty of the support within this ongoing short-term uptrend. So I think while we anticipating some sort of the consolidation, the short-term pullback could be giving us some sort of opportunity for us to accumulate on weakness. So that for the FTSE Asian 40. So we're expecting uptrend to continue once the selling pressure has been normalized. For now, short term is actually looking more on the consolidation. All right.
Nick,
Yes.
Nick, if I could just stop you there for a second, and looking at your chart, that point where the FTSE ASEAN index did touch the support level, was that triggered by perhaps an interest rate event or the Fed's, talking about the fact that interest rates might be higher for longer?
That could be one of the factor that come into play. But regardless, the FTSE Asian 40 tracking the major stock in Asian, largely I think most the biggest coming from the Singapore stock, as a few from Malaysia and the rest of the Asian regional. Now the thing is, the reaction is I think pretty much more on the basis that the profit taking after the recent rally. So the profit taking is pretty much I would say is healthy in the ongoing uptrend. Now, if you taking into what we call it consideration the interest carry trade kind of play, there could be more what we call it a reaction on this on the chart. As per today, the FTSE Asian 14 open slightly higher, but now currently lower about 0.23%, could actually give some sort of indication that the consolidation could actually continue. The thing is the concern right now, if the index taken out the current support at 10,200, which means this consolidation could turn into much more a bigger correction. So for now, I think it will be the best time to look into right now is actually within 10,200, which the critical support for the index right now.
Got it. Thanks. Thanks. Let's perhaps move on to the FTSE STI. Let's have a look at the chart over there.
Now, the STI index is quite interesting. If you look the past few months, I think January last year, the STI index is pretty much, I would say, a range bound. There are multiple attempts for the index to try to go above the 3,370, which is consider strong resistance level, but it was failed to take out. And I think for the past few weeks, the range become much more smaller. If you look on the screen, the yellow line, it was being representative of the two level 3095, which is the current support, and through 3260, which is immediate resistance. What may interesting, the index has been trying to test the minor support, but somehow the buying interest is still pretty much there. Hence, or you can see a new higher structure was in place. But in other hand, as the index tried to go up further, 3,260 become pretty much a ton for the index. We've been unable to go out beyond this level. So if you look on the reading momentum alone, it was flat. And it is give us some indication that it could possible to trade higher. But right now, we need something more tangible in terms of the trend move, which means a breakout above 3260 is needed as a validation in order for the overall trend to continue on uptrend. Failure to do that, we're expecting the consolidation to continue at least near term.
Okay, great, thanks. Then let me ask you, in light of the developments here, particularly for the STI market, uh, what may be one sector that you would park your money to in the event of a slight or moderate correction?
At the moment, we think REITs actually showcasing some sort of their interest. I think we did highlight risks in that. Can we take a look at that one of the chart that we highlight on today? Risks actually showcases some sort of the rebound, which I think has a decent chance to trade higher, at least near term. There's another chart here. I think IHS REIT index, which is something that we highlight into this report, right? As per last week, we expecting the index to still correction, continue correction, while it was indeed traded lower, but the downside was kept within the psychological level of 1,000. So this actually creates some sort of barrier. And if you look past a few years, this so-called level has been quite a strong and firmer support base for index. The trend is still on the downward, but we think technical rebound, at least short-term recovery is possible, building on the much more stronger what we call that higher structure, stronger interest and momentum build up. If you look on the RSI now, the blue line is traded above its two average line, which means momentum is actually start to pick it up compared to before. So because of that, we're expecting at least a short-term movement could leave the REIT S3 index toward at 1,090, and the next resistance will be at 1,140.
Okay, thank you very much, Nick. We'll leave it for there. Your observation about the REITs sector is clearly very interesting. Some of you may recall that at the beginning of the year, actually in the fourth quarter of last year, towards December, actually the REIT sector have actually started running and have done phenomenally well. But the pullback has occurred this quarter, quarter one of this year, and your points here, Nick, does certainly complement the idea that this sector is coming back into value, and we do also agree with you that there may be fundamental trading opportunities. So thank you for that. And our next speaker is also going to continue on this point. He's none other than Krishna, who's basically our regional and Singapore REITs analyst. So let me first just ask Krishna to basically talk about the two stocks or the two REITs that he's most enthusiastic about. The first will be EREIT or Elite Commercial REIT, and the second will be AIM. So let me just get Anand on the call to start on EREIT first. Krishna, could you
Yeah.
run us through this, please? Thank you.
Thank you, Senor. Thank you very much for having me. So yeah, I think perfectly in line with what Nick has mentioned about how the technicals stack up for the sector. I think investors should look at the ESR logos REIT, EREIT SP, and AIM's APAC REIT, AAREIT SP. I think both these names are trading at about 8 to 9% yield. And in terms of book value, generally the industrials trade above book, but these two are trading at about 7 to 8% discount to book. So I think valuation wise, I think you do have both the metrics kind of satisfying the counters. Also, if you kind of look at the other quant metrics, both the names, especially AIM's APAC REIT, also has a very high score on low volatility as well. So risk reward wise, I think AIM's APAC REIT also stacks up quite well. I think there can be, if the few catalysts that investors are looking for, like the interest rate cuts, if it is somewhat more deeper than what markets are expecting, then definitely the beaten down names with high yield, low price to book should get a bid before other names. So I think on those two metrics there, these two counters again act very well. On the fundamental side of things, there have been few events for both of them. Both of them have done a capital raising, have reduced their gearing, and I think markets are now looking forward to where the deployment comes from, how the DPU outlook, which has gone down by close to low teens percentage point, how the DPU growth comes back, and then how the overall sector trades in light of the fact that the logistics supply is starting to come back into all the cushion that has all the developments that have happened so far. So I think the key thing, obviously, investors need to be reminded of is that if there is any technical rebound on valuation, then these two names definitely stand quite well poised to capture the technical rebound.
Okay, thanks, Krishna. Maybe just as a last note on the REIT sector, because we have some clients who have written in to inquire about the prospect of REITs that are basically exposed to the U.S. commercial property market. I believe those REITs are also probably subjected to the same downward trend that we see in the overall sector right now. Do you think now is the time to basically look at some of these property REITs?
I think definitely once for the technical rebound, you don't need much of the fundamentals whereby you look at the demand supply, the bank appetite for lending, and so on and so forth. I think the fact is that they are pretty much close to what penny stocks kind of trade at. So you will get the multiple kind of appreciation in the share price, but whether there can be any fundamental drivers that can result in a sustained re-rating of those names. I think they are trading at probably a fraction of the book, and the book itself is kind of a question mark right now. But whether there can be any sort of fundamental drivers to that, I think we need to have give the sector a bit more time. I think the existing supply needs to be taken out. The banks needs to be a bit more comfortable about lending towards the sector, and then we can see a lot more durable re-rating for those names. But meanwhile, I think you can always trade these technical rebounds, and especially once there is some bad news and there is a big crash, probably position yourself for that, and then once the rally, then you want to lighten up your positioning there. I think that's how I will probably position for those names and give the sector a bit more time to get its footing and some good fundamental story to come up with.
Okay, great, Krishna. Thanks for that sage advice. I will leave it there
Thank you.
for the property REITs. Thank you. So on the topic of high yields, I'm going to come to my last stock right now, which is Genting Singapore, and this is an interesting development. So on 28th of March, Thailand basically took the first step towards legalizing entertainment complexes or ECs that will house casinos. The framework is very similar to Singapore, but with a lower tax rate. Now, we do see a trading opportunity here if Genting Singapore pulls back. Genting Singapore's Resorts World Sentosa derives about 60% of its gross gaming revenues from foreigners. So while the first impression here may be that these assets will face extreme competition, history may actually prove otherwise. One has only looked at Genting Malaysia when Resorts World Sentosa was first opened in first half of 2010. Then market investors that were betting that Genting Malaysia's gaming revenues would fall after the Singapore integrated resorts open were basically proven wrong. So we think that the same play out for Genting Singapore might actually open up another opportunity to get into the stock. And we just want to highlight to our clients this afternoon that Genting Singapore is basically yielding about 4.5% dividend yields for 2024. So check out Genting Singapore. If there's a pullback, we think there's a buying opportunity for Genting Singapore. And also, perhaps just to remind everybody also, is that Genting Singapore will also be investing about 6.8 billion in terms of capex to upgrade its facilities. And it's also public information that Genting Singapore, may be considering tendering for the EC license in Thailand as well, right? So we'll leave it there. These are the few names that we're watching this week. If you have any further questions regarding these names or additional stocks that you may carry in your portfolio, please feel free to approach your sales representatives, and we'll get in touch with them to basically get back to you on some of these on your burning issues. So with that, I'm going to leave it here. Thank you so much for spending this afternoon with us, and we look forward to seeing you again next week. Thank you very much.